Hi, this is Charlie Aitken of investmentmatters.club. The Dow Jones Industrial Average, better known as the Dow, and perhaps the most watched stock index on the planet, is at a crucial point, and it's supported by technical observations made here and within the weekend in 4th of October Investment Markets Overview, which we've entitled Fives and Threes, 61.8% and a Gap. Apologies to you if this sounds like gobbledygooch, but the purpose of this brief overview will explain what I mean. But before we get to that, it's worth a reminder that the majority of investment analysts look at market fundamentals such as supply-demand, price-earnings ratios, or its reciprocal earnings per share. But the problem with fundamentals alone is that they often provide confirmations after the price of a security has changed trend from up to down or vice versa, and sometimes they correlate with a rising share price or index, and at other times with falling prices. A chartist, better known as a technical analysis practitioner, which includes yours truly, prefers the forward-looking guidance provided by a chart. A trend change is obvious, and if we look at a long-term chart, the blue lines are trend, and as you can see, it's pretty obvious there. And when there's a change such as here or here, a larger one there, then visually it's a lot more useful. So apart from that, the use of tried and tested fractal patterns, indicators and sentiment readings usually provide really useful targets to where an investment price, be it a share, bond price, commodity or an index, just to where it's headed to. Also, fundamentals can be manipulated, whereas a chart's major benefit is they do not lie. Price is what it is. You can't manipulate that anyway. Usually a chartist will study a chart at different time frames, starting with a long-term monthly or weekly data chart, and then zoom into a daily and perhaps even an intraday chart, particularly if one is a short-term trader as opposed to a long-term investor. That said, there are times, such as after a very long-term uptrend or downtrend, when volatility increases, and it pays to be very aware of the shorter term. We've zoomed in here to a 30-minute intraday chart, so every one of these bars, whether they be red or black, is 30 minutes in duration. Of the tried and tested guides that I use for technical analysis, I've selected three important ones. Elliott wave fractals, which travel in fives and threes. Let's just pause on that. As we can see here, there's 1, 2, 3, 4, 5, which suggests that the major trend is lower for the Dow Jones Index, and that's interspersed with, that's too tiny to see, but that would just be 3 in the other direction, 3 there, and then a larger 3 here, and that's suggesting, as I say, 5 being in the major direction, interspersed with just a corrective 3 wave move the other way. The actual fractal pattern is, to be fair, a lot more obvious on longer term charts as opposed to intraday, but the same pattern repeats over and over and again, whether you're looking at 30-minute charts as is here, or whether you were looking at decade by decade chart. Either way, the second point raised was 61.8%. Well, that's probably the most important ratio within what's known as a Fibonacci retracement tool, where we just join that high there with this low, and it has predetermined targets here where price tends to hesitate or move to and then reverse and start going on the main on the direction of the main trend. In this case, you can see that on Friday's close at 26,573 for the Dow Jones index, we're right at the 61.8, which is normally a pretty good guide of the extent of the correction. It also offers a little bit of like a comfort blanket. You tend to find that if it goes up, continues to rise up to, say, the 78.6 or just over, that can be a warning to say that actually you're wrong in your analysis and the decline's over and it's about to continue higher and perhaps far higher. But at the moment, that looks pretty satisfactory. And it's supported also by this third mention about gaps. And I've highlighted here with this green circle a gap that was left on opening on this particular day here. And you tend to find that within charts, gaps tend to be filled, as indeed this has gone up and filled there. It's also suggesting there may be a gap here to fill on the way back down, but that's for the future to tell us. If we zoom out in time, this time we're going for 2-hour charts, each one of these bars out from what was 20 days out to a couple of months, which coincides with the mid-July all-time high for the Dow Jones index. We can observe two things here. One is there was that 5 waves down, 1, 2, 3, 4, 5, followed by a slightly larger period, 3 waves back up, but it halted, so this is corrective, and then it started to come the other way. And also the use of the Fibonacci, it actually reversed here at, having measured the wave 3 down, it retraced between 50 and 61.8%, which was quite useful before it turned and finished off the wave 5. Now with this current one, we can actually say we've had 1 wave down, second wave corrective, then a third wave down to here. This looks to be a wave 4 before a wave 5 comes in, but as mentioned just now, we've at least got a risk control here, being this 78.6% level here. And the second point that I was going to mention on this slightly longer term chart is that there are plenty more gaps all the way through here, and surprise, surprise, they've all been filled. Been filled there, been filled there, been filled there with these couple here. So they don't always, but they tend to in the majority. But what we can also do with Fibonacci is it's very useful for assisting us to predict going forward. But this time we use the Fibonacci projection tool as opposed to a retracement. And all we do here is we take the first fall that was from mid-July through to early August, retrace it back up to around about September the 9th or 10th, when it started to move over again. And this time what it does, it projects forward 100% of that fall. In other words, equality would bring us down to about 25,275, or if we carry on down to this 123.6%, it's at 2470. So that's actually suggesting a possible 5 to 7% fall, which, you know, is a reasonable loss for people, and it could possibly be more, and even a lot more than that. So there we have it. We've got 3 guides to assist in identifying the trend. We've got a means of predicting the likely next move for the Dow Jones, and we've got a tight risk control to reduce loss if we're wrong in our analysis. So hopefully that's been of. If it has, then do look out for future tutorials on investment made easier, or better still, for the price of a decent dinner for 2, you can lock into our discounted investment timing solution, which includes a 30-day money-back guarantee, and this covers 5 major stock indices, including the US and the dollar price of gold, all of which are at interesting turning points. Details of this are via the link below. But let's finish for now with the obligatory health warnings. And if you enjoyed this presentation, then do give us a like or otherwise. Thank you very much. See you next time.